Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
G'day everyone, welcome to the Smart Property Investment Show. Thanks for tuning in. Phil Tarrant here. I'm the editor of Smart Property Investment, also host of the show. Bit of a treat for everyone today, I think. Well, for a lot of our listeners, I think it was a treat. Some people may find themselves snoring asleep at the wheel because it's going to be so boring, because we're going to be talking about accounting. So I've set all this up in a really good way to introduce my accountant, Monzerul Khan from Keshab, he's looked after my property portfolio since the day dot, and I've already given him a hard time by calling him boring because he's an accountant, which I do not believe in. Accountants are the most interesting people in the world, but I have fortified myself with a very large coffee here, because while I get and understand accounting, sometimes the nitty-gritty of it means I need to be alert and on guard. So Monzerul, welcome to the show. Thanks for finally coming on.
Thank you very much, Phil. It's an absolute privilege to be here. Thank you. It's
good, mate. It's look, I lean on Monzerul pretty hard. We've got an interesting working relationship, and we'll talk about that over the next sort of half an hour or so. But I have confidence in Monzerul to get this part of my portfolio sorted. So I sleep easy at night knowing I have good people on my team, and Monzerul was critical to that. So I've probably never said thank you for what you do. I pay your money, right? But I do really do appreciate the work that you do, and how you've helped me grow a really nice portfolio, and we'll discuss that today.
Sure.
And I've also asked someone else to come on the show, also big part of the team as well, Michael Johnson. Michael, how you going?
Hey, not too bad, Phil. How are you, mate?
Good, mate. So this is the first time you've ever been on a podcast, Michael?
It is the first time I've been on a podcast, yes.
Good. Okay. So Michael works with us here. He works within our finance team. And as well as doing all the stuff we do as a business, Michael really supports me as my eyes and ears and go-to guy for everything sort of portfolio related. So his role here is a bit diverse, because you do the business stuff, but then you also have to deal with me and yelling and screaming about getting me stuff for my portfolio because my broker or my accountant needs it. So
yeah, there's always plenty to do. Here.
There's plenty to do. So Michael interfaces. I'm just trying to paint a picture here, I guess. Michael interfaces with Monzerul's team,
sure,
to help deliver Monzerul the information we need in terms of tax time, but also as we go through executive sort of financing of property. So the objective today, Monzerul, and it's probably going to change to how we sort of start out with, but a lot of the questions we get around our portfolio is geared towards its financial performance. So why do you invest in property? Why do I invest in property? Why do most people invest in property? It's a wealth creation tool. You don't do it I do it for a bit of fun, but you don't do it only for the fun. You do it because you're actually trying to achieve something, and that's wealth creation. A lot of the questions we get is around the path that we've embarked upon in terms of wealth creation, and how the different stakeholders we have to help us do that and the role they play. But a lot of the questions are always around accounting. So I've given Monzerul the brief to talk completely open and transparently about our portfolio. He knows it as well as what we do. And we're just going to explore some of the drivers of this portfolio, some of the successes, the position, how we've been able to realize wealth creation through leverage, how we've been able to realize wealth creation through buying really good properties. And I'll preface that also with the fact that, and we've spoken about this before on the show, that an accountant is essential to any property investor, but not all accountants are created equal. Now, Monzerul's ex-PwC, I think, so you have a very good pedigree as an accountant. From a business sense, very good, but from a property sense, you're also a property investor, and that was important to us when choosing an accountant, that it was someone who actually understood property.
That's right, mate. The privilege that I have is that I started back in 1999, and that's when I sort of bought my very first property. And I still look back and I sort of say that why did I buy the very first property? It was my father sort of said, you got to buy the property. And I still remember at that sort of mid-20s, I suppose, one sort of says, why would you buy investment properties? It's shares. You buy the shares. Shares are exciting, right? So you can check it on a daily basis. It goes up and as such. So my father said, no, go with the brick and the mortar. It's the safety, it's the security, it's the tangibility, it's the asset that you can see. And that's where I started and the journey began.
That's good. So I won't disclose, I know a little about Monzerul's portfolio, so I won't disclose just how big it is, but for our readers, Monzerul has a significant property portfolio. He's been at it for 15, 16 years?
17 years.
17 years or so. And Munzerul, I'm not going to call Munzerul aggressive in terms of his drive to build a portfolio, but I'd say you're more on the proactive side. Is that fair?
It's about being consistent performance over a period of time, right? So it's about being time, and it's about being time in the market as opposed to so much timing. Now, I see many investors, as an example, that in the first year they buy 3, 4, 5 sort of investment property, or at a point of time they do, and somehow the life sort of takes priority and sort of other sort of priorities sort of come in as such, and it just doesn't seem to happen for another 3, 4, 5 years. Then you sort of look back and you say 3, 4, 5 years of the opportunity gain, so to speak, is being lost. So it's about consistent performance every year. It's not about any level of, I suppose, race with anyone. It's about having your own goals, own SMART goals, and how do you track with that sort of own SMART goals, and how do you keep yourself accountable?
That's a very good point. One of the things I like about working with Munzerul is the fact that he has a property portfolio that I would like to emulate, and I think we're sort of on that path now. And our portfolios, size-wise, are different, but they're probably the makeup of them are probably quite similar. So it's something we talk about on the show a lot, is to find people who and associate yourself with people who are doing something that is something to try and emulate, particularly in property investing. And your portfolio, Munzerul, and your guidance and expertise is good, and it's something that we get a lot of value.
Thank you.
Outside of the client sort of accountant relationship, as in terms of the building side. So what I think is probably the best way for us to start, Munz, and just for our listeners, this is completely unscripted. We've got a bit of a spreadsheet here that Michael works on quite a lot, which sort of paints the picture of our portfolio at any given time: equity position, debt position, LVR position, yield position, this sort of stuff. But I think what I might do, Munz, and you deal with a lot of property investors, most of your clients, a lot of your clients are property investors. Tell me about my portfolio from a external perspective.
Phil, if I go back on day one, so we've been sort of with yourself in terms of the property investment for last about good 4 years now. So what I did is that I've done a little bit of sort of a spreadsheet in terms of to go back with the financial accounts to understand more from a financial perspective that how is the portfolio performing, right? So we do very often the due diligence, I suppose, at the time when you sort of purchase. We say that, well, that's the expected return and these are the expected expenses, and we expect the property to be break even, give or take, right? So that's sort of a little bit of a hypothetical in advance that you do the due diligence. That's important. That's good. But along the way, you need to do sort of consistent and continuous sort of a due diligence. Yes, that is what we expected. How we performing as such? So I look back into your portfolio, mate, and I look back and I sort of say that you started around 5 years ago, roughly, just touch a bit over 5 years, in terms of your business portfolio as such. So we looked into a whole lot of things. We looked into structure, we looked into diversification, we looked into what types of properties we buy, we looked into selection of sort of properties, we looked into the tax side of it, and we looked into tax in terms of not only the immediate sort of the tax sort of opportunities or tax sort of minimization, we looked into longer term sort of a tax perspective as well. We looked into more sort of a strategic planning, right? So what's the succession planning? Perhaps prior to that, what's the retirement planning? So all of those things being considered, right? So at a high level, if one sort of considers your portfolio, is that you started around October-ish 2011, and initially we had our Trust One. And Trust One, that we sort of in the first year, you purchased about 4 investment properties. Then we look into the next financial year, which is 2013 financial year, and then you bought another 3 investment property in that financial year. We looked into the subsequent financial year, you bought another investment property. We look into 2015 June financial year, there's another 4 or so investment properties being bought. So there's about 11 investment properties that you have, and those 11 investment properties are in between 2 different trusts. So if I look through the performance of those sort of properties and performance, if I look through purely from a financial side of it, right? So I started about $250,000 as a cash, and that $250,000 cash that you started, that's your own capital. You went to buyer's agent saying, guys, this $250 is what we have. Let's build that portfolio as such. So you build that portfolio. And when we look back into this sort of portfolio as at today's value, depending on how the valuation is, you're easily looking over 5.2 million as sort of the gross value, if not even higher than 5.2, based on what the valuation is, right? And then if I sort of look through that, what was the purchase price? The purchase price for all that 5.2 million was about, give or take, is about 3 mil. And then you had a whole lot of incidental costs, right? The general sort of a 5% that we sort of add away, the stamp duty and sort of solicitors cost and so forth. You had a whole bunch of repairs and maintenance and renovation, so to speak, right? So when we add away all that initial cost, the incidental cost, the renovation cost, roughly it's about 3.4 mil. So 3.4 mil was the overall purchase price with 250,000 as initial capital. The market value as of today, let's say 5.2 mil. So there is about 1.8 million of net equity pre-tax, pre-selling cost as such. So I take a step back and I say that, well, Phil, at a very sort of a high level, I suppose, 250,000 over a period of time achieved about 1.8 million gross pre-tax and pre-selling cost. And if I try to do the return on it, on 250,000, the compounding return, believe it or not, is 49%. 49%.
Is that good?
That's brilliant, Michael.
Oh, that's amazing.
49%. And how many times that we go into the open world and we hear from a whole lot of fund managers that, you know, we had a double-digit growth and we did really exceptionally well. We beat the stock market by that sort of margin as such. 49%. And it's not 49% in 1 year. It's a 49% of compounding return on return over 5 years. Brilliant.
If I was going to play devil's advocate, just say if I was going to pick apart this portfolio, I'd say, no, well, that sounds like bullshit. It's not possible. Or I would say, you must be doing something so risky to get those returns because it's just not possible.
And you know what's funny? That is exactly how it sounds. That is exactly how it sounds. But as it is that the listener sort of knows your portfolio, that all of your properties, the 11 properties, none of them are sort of any sort of a really waterfront, sort of a fantastic blue chip. You've got a blue chip property as such. But most of your properties are sort of a little bit, with all due respect, a little bit lower socioeconomy, sort of an area that you've got quite a bit of population, quite a bit of infrastructure, and sort of the rental return demand and sort of the immigration demand as such. You haven't really done anything extraordinary other than saying that you have taken action at the right point of time in the right cycle as such. So there's no question that if I look back into your portfolio, the first few properties when you bought, that you bought them back in New South Wales, and there was the market at that stage that New South Wales and Sydney market in particular was quite expanding. So you bought it. So you've taken that sort of a growth as such. Then you knew where to stop in New South Wales, which you did. And then he moved outside New South Wales because he said that, well, you know, there's not so much value in New South Wales anymore. So you moved outside New South Wales. You moved into Queensland at that stage, right? And you've seen the value on the Queensland. And then the Queensland market's sort of done very well. So I suppose when we say 49% compounding growth and using your term, is it really bullshit?
I know you don't swear, Munzrul, so...
There is a one-off gain because you bought it at the right time at the right market. But was it just a pure luck, Phil? Or was it because of a whole lot of due diligence that you've done? And I would dare suggest that it is the due diligence, and that's where the team comes in, your buyer's agents comes in, and your buyer's agents are the ones who sort of bought it with yourself. But the market has increased.
So any luck? Is there any luck at all?
I think luck is to some extent is what we make.
You manufacture luck, just like equity.
And the manufactured luck is that you made the decision. It's the opportunity that you have taken. You know, I sit down with investors all the time, and the investors sort of ask that, I ask, what is the risk? And we go through a what-if calculation. We say, what if there is no rent? What if the property sort of is being damaged? What if there is a malicious damage? What if this happens, that happens? What if that the interest rate finally does go up as RBA just started to speak? What if we go back to 15, 17%? I doubt it. So we look through many what if. We look through the overseas. We look through the international what if. Then I sort of ask a very last question. What if you do nothing? And the answer is that nothing will happen, right? So any action arguably is better than no action, provided that we have our level of due diligence and sort of care as such. So based on the numbers that you've given, assuming that it is 5.2, which sure, obviously is subjective, but it's reasonably conservative of the valuation.
Bank valuations. So,
so 5.2, and you started with 3.4 mil, so you're 3.4 over 5.2 with a 250 odd thousand over a period of 5 years. That's the return. Then we look through from the cash flow side of it, right? So the cash flow is also important. So we looked into the growth, and we sort of say, well, how does it sort of perform from a cash flow? Now, the way we did the cash flow is that we've accounted for all of your cost. All costs are being accounted, including all of your borrowing cost, all of your buyer's agency cost, all of your incidental cost, and so forth. And I'll sort of see that in the first year, that when you had 4 investment property overall, your negative cash flow was about 34,000. So it cost you a bit to hold it.
Yep.
Then I sort of say, well, move forward into the next year is your overall negative cash flow was about 41,000, but you bought few additional properties. So negative cash flow increased a bit. Then we move into the third year and we say that, hang on, your overall negative cash flow seems to drop a bit. So that's about 31,000. And then we look forward to the fourth year, which is 30th of June 2015, and your negative cash flow is about 28. So the trend that what we're seeing is that while it was initially quite a bit high, then it's sort of seems to have increased a bit more because you had more properties being embedded as such. Then it has started to sort of reduce a bit because as the rents have started to increase, and to some extent, I suppose the interest rate is stabilizing, right? So when I add away all of those 4 years, your pure cash loss was about 134. And that's an important point, right? That's $134,000 of pure cash flow, and you sit around in here and say how many people can afford it, how many people wish to afford it, that 134. But when one sort of analyze that a little bit more, one sort of says, well, there is a bit of tax benefit. And what is the tax benefit? Many people do the tax benefit at the highest marginal rate. But even if we are conservatively, let's say that we take it at a pure corporate rate of 30%, we get a whole bunch of tax benefit, roughly give or take about 40 odd grand. And there is a whole lot of depreciation that you had with all of those properties as well, which also provides us a tax benefit of 26 grand. So if I take away the tax benefits attached to it, your 134,000, which was loss, comes down to about $68,000 loss, right? So the two important numbers, I suppose, in here is that it cost you over 4 years, give or take about 134,000 pre-tax, and it cost you about 68,000 post-tax over 4 years. Now, 30th of June 2016 numbers, we're still doing it. And then I suppose from July to November. So one sort of argues that that 68 will increase a bit. What's the number? We don't know. Let's say about 85, let's say about 90. So, 250 odd grand as your initial capital to bring into about 1.8 million is the equity, pre-tax, pre-selling cost you roughly about 68, let's say about 85 when we add away that 2016, 2017. Yep. My view, brilliant.
It's good. It's a good summary. And I guess there's two, if we stopped buying properties and just sat on this portfolio for 10 years, 15 years, didn't add any new properties into it, that position in terms of in the red would move up into the black as the property portfolio matures. That's correct.
Absolutely. Two points in here, right? So one is that in terms of from your cash flow side of it, is that it is expected that the rents are sort of consistently sort of increase over a period of time. And rents do, right? I look back into my very first investment property that I bought back in 1999. The return at that stage was good. It was about 7.5%, right? It was just a standard sort of a 3-bedroom house. And I look into that particular property now, and if I compare that with the original purchase price, the return is about 32%, right? Simply because that it is the period that I've given, it's the time of that 17 years that I've given, that the rents sort of consistently sort of increased over a period of time. When I bought it, the rent, as at today, these are both market rent and nothing sort of extraordinary. So rent sort of increases, that's one point, and definitely your sort of, the holding cost, I suppose, will decrease over a period of time, assuming that the interest rate sort of stays more or less within some level of range as such. The second point which I want to say is that, well, the number seems brilliant of 49% that we suggested, but 49% is over 5 years, right? And because it is a compounding return, we sort of expect that over a period of time that 49% progressively will drop. but it's still 49%. I'll take it.
It's pretty good. An important point here, Munzrul, and I think it's probably worth chatting about, is that this is the real world, right? This is no, oh, well, let's not count that because it doesn't really matter. This is real, right? This is no bullshit. This is what it is, right?
Mate, your Excel is one of the most detailed Excel worksheet that I've seen, and this is what I see on a day in, day out basis. I see all the sort of Excel on day in, day out basis. You've counted absolutely everything in there, and having Michael with you as well is quite a bit of privilege as well, because Michael sort of ensures that absolutely every single deductions are there. You count everything, absolutely everything in there. So this is your true figures.
So let's do a what if. Okay, so some people would say, okay, $134,000 over 4 or 5 years is a lot of money.
Yep.
How do you afford that? Well, let's break it down. How much is that over a 5-year period? It's what's that? 20 something grand a year, right?
That's right.
Not a lot, really. Well, it's a lot of money, but I'm able to cover that.
Absolutely.
So I'm confident in my ability to earn income to cover that, plus meet all my other expenses. So that's okay. But we invest in a trust structure.
That's right.
Which means that we're paying land tax.
That's
and
right.
because we're very New South Wales heavy, we're paying land tax on every single one of those properties. If we were investing outside of a trust, we wouldn't have that land tax in there.
And that's a very important point. That's a very important point, because as part of that calculation of that 130 odd grand, I've taken the land tax as a cost.
Yes.
I haven't added back the land tax because I said this is your true cost. And your land tax is quite a bit. And in one of the year, that land tax
it's hard, yeah.
was quite a bit.
So the privilege of investing in a trust has a negative consequence in terms of cash flow. So I need to weigh up the benefits of investing in trusts versus what it's going to cost me to invest in that trust. Now, there is tax compliance, statutory stuff associated with that, and I've got to pay you more money to do my returns because it's within a trust, right? That's just a reality of. I'm not asking for a discount, mate. Don't worry. but that's a cost, right? That's a cost. Because I invest in a trust structure, and secondly, I pay land tax. Now, if you took that out of that, your numbers, and this is what if, the numbers would start even looking even better, right? Because there's less costs in the portfolio.
Absolutely. Because see, the cost where the trust sort of cost comes in terms of the compliance side of it, is that from an accountant's perspective, I suppose accounts to be prepared in addition to your tax return. So naturally the cost is a little bit higher. Even from other sort of an admin point of view as well, you got to pay a whole bunch of ASIC fees, the annual fees. So costs are definitely higher. And the land tax is higher as well, because as he said that in New South Wales that there is no land tax threshold in trust. In Queensland, there is a bit of threshold, 350, but it doesn't go a long way. But it is for each trust, mind you. And in Victoria, that there is a little bit of threshold, 25 grand or so, but after that you pay surcharge. So there are costs, but I suppose the decision why we made it, we take a step back and we look through what's the structure, why we have done that bit of a structure, what are the benefits as such. So asset protection first comes into mind, and asset protection is quite important. Trust is as it is, that you really don't own it, you control it. You're the ultimate controller, but not so much as the owner as such. The second thing where it comes in is that in the longer term tax planning. So any investment, any business, one has to take an exit plan. And if you sort of consider what is the exit plan at a particular point of time, that's where one sort of sees the benefit of a trust, that you can distribute the profit on a discretionary manner on the basis of the trustees sort of a representation as such, and you receive that 50% CGT discount. So there are some significant tax benefit in the longer period of time.
So I'm paying it forward pretty much.
That's right.
And that's the important point for our listeners, is to, when you're looking at property investment, one of the critical things is structure, and getting the structure right from the get-go, because a lot of people make the mistake of setting up the wrong structure initially and then they get stuck in the future, and that's a bad place to be. So the point here is to speak to your accountant. So going back, Munzrul.
Yeah.
So I'm looking at the numbers here, and it's cost me essentially $1,000 a month in cash and money out of my pocket to hold this portfolio over a period of 4 to 5 years. So
That's
it's $1,000 I have to find every month.
That's
put into
right.
it. Okay. There's 11 properties. Obviously, it didn't start at 11 properties, so it's sort of grown over time. A lot of people will say, wow, it cost you $1,000 a month to hold an investment property. And I go, yes, that's true. $12,000 a year, give or take. And then, but for the $1,000 I've given out every single month to service this portfolio, I've created $1.8 million.
That's right.
That's the summary of this, right?
That's right.
So what pictures does that paint to you? Is that the power of leverage, Or is that the power of buying the right properties? Is that the power of the right strategy? Is that the power of the right structure? What is it?
Brilliant question. I think the answer is a combination of all of the above and perhaps a couple more as well. So definitely it's the power of leverage. It's the compounding effect. And I would probably dare suggest that, Phil, that even though the compounding rate of 49%, if we look forward now in about, say, 5 years, 10 years' time, I would strongly argue that that will drop. Definitely will drop, just how the numbers sort of work. But you would still say, because you would have growth on growth and growth and growth as well, you would have that a snowball effect. And with that snowball effect, you would see the compounding effect. So one would probably dare suggest that the portfolio in no shape or form being matured as such. It's just reached at a stage. So it's definitely is a combination of your leverage, because you've effectively utilized 250,000 to own an asset base of 5.2 million, right? And those 5.2 million is because of that 250,000. Even if we look at 3.4 million purchase incidental cost, that's coming in from 250,000 as such. Definitely that. But it also comes back with the strategy as well, right? And the strategy in the sense that, I suppose, is that when you bought it, as you bought it in the right market, in the right cycle as such. And you know what? I say that very often. You don't need to buy, I'd love to buy, but you don't need to buy once in a lifetime sort of a property every other week as such. You just consistently sort of purchase the market value of the property at the market price and let the market do its things over a period of time, as long as you buy it right in the first place. So what are some of the selection criteria that I suppose you had in the first place? And correct me, because you had your selection criteria. So you looked into an area that where there is a little bit of cafe culture, suburban area, but not too far. So it's not a regional area as such. Infrastructure was there, the population was there, the growth was there, the demand was there as well. And more importantly, the rental return was there of the demand. So your couple of initial sort of properties that you bought initially, what were the return? What were some of the gross returns? 6.5%, 7%?
They're up there. Yeah.
6.5%, 7%, right? So exactly the same property, if you consider now under the current market value, I'd probably dare suggest there would be hardly about 4% or below than 4% of the gross return. So exactly same property, if you were to buy it today, and if you look forward in about, say, 5-7 years, your growth is not going to be in the same pro rata as the growth that you achieved in New South Wales. And that's exactly the reason why you bought it for a period of time and then you moved outside the New South Wales as well, because you replicated that process in the right level of market. And by doing that, Phil, what you have also achieved in longer period of time is that you've also achieved this diversification in the longer period of time. Because as it is that while you have the cycle of the market, each state arguably is sort of a little bit on a different cycle. One argues that is New South Wales matured. One argues that is Queensland is still growing a bit. One argues that Melbourne is probably a little bit in the middle, right? But if you have a combination of all of those, you would see that at some point of time, some market is sort of moving. So while you have New South Wales, while you have Queensland, while you have Victoria as well now, you're sort of reaching into that bit of diversification. So quite a bit of a strategy, right? And then the structure, of course, it comes in as well, quite a bit of the structure as well, because of your protection. It's also good of saying that we're having all of those sort of investments and everything else, but if we can't protect it, then there is no use. And it's also good saying that, yes, we have all these investment properties and down the track when we sell it, and if we need to pay 46.5% tax with absolutely no level of discount, then that also doesn't help as well, right? So it's the shorter period of time as well as longer term that you've considered.
That's very good response, Munzrul. And you look at a lot of portfolios of investors, Munzrul. What is it that concerns you the most about my portfolio?
Look, when you're saying concerns most, I'd probably
from a taxation, compliance, growth perspective, any way you want to frame it.
Excellent. I'd probably dare suggest that your portfolio is yet to be matured in many different ways. So you've got a whole bunch of properties in New South Wales. You've got a whole bunch of properties in Queensland as well. And then one sort of suggests that, well, perhaps whether we can diversify a little bit more. And one doesn't need to diversify for the sake of diversification. But in an ideal world, if you have New South Wales, Queensland, and quite a bit in Victoria, you do have one property in Victoria, but quite a bit more in Victoria, then you start taking that sort of a cycle as such. That's one. The second thing is that you do have it, but I would like to have it a little bit more, is that you have your natural growth, So what we spoke at that 49% is fundamentally is a natural growth with a little bit of renovation and capital improvements that you've done along the way. But I'm a big fan of saying that if we also have the second driver, which is the manufactured growth, so bigger sort of a land that we can sort of subdivide, bigger sort of a land that one can sort of have a little bit of sort of investment at the end, or you can have granny flat and those sort of things, right? So those are the ones that we do have it, but I would like to have a little bit more, I suppose, if I may.
And we're working on that right now, and we'll chat about that in another podcast. What we're up to in terms of our buying, and I know on a show recently I committed to buying a few more properties this year, and I can let all our listeners know that it is happening, and pre-approvals are nearly there. So I'm really excited about the prospects moving forward and working with you to help realise that. I guess maybe a question for Michael. So outside of so we've sort of let you've played a key role in helping us manage this portfolio for about a year or so now.
Mm-hmm.
You're a young bloke. What are you? 21 years old, right? Just finished accounting degree. He's a smart bloke, Michael, who I think as an accountant has a lot of prospects in that he gets the numbers and gets the mechanics of being an accountant, but he's able to think strategically, and it's one of the reasons why it's good to have you on this portfolio. Your perceptions about property investment before you started working on this, whenever that was, let's call it a year ago, compared to today, and actually seeing this, you've done most of the work on this from a liaison perspective with our financials and working with Munzrul's team. What do you think about this portfolio? What do you think about property investment?
For me, before I joined working for you, Phil, I've had no real exposure to property investment. I didn't really see it as an investment decision, like moving forward, that sort of thing. I didn't really have that sort of future planning thought process. Once I got thrust into the portfolio life, working with you through this portfolio and seeing the growth and seeing the changes in the portfolio and the interesting things that happen and the thought process that goes into it, working with you, Munzrul, and going through some quite complex things that are happening and looking at some really interesting facts and some really interesting ways to look at it to actually see the performance. For me, property investment now, I see it as a really great tool for young people to get into. And I think this is really going to help me as a prospective property investor myself now, sort of looking towards buying my first property. It's just interesting to hear everything that Munzrul has to say, because it's really helping me form my views about how I'm going to approach my portfolio, because I know there's a lot of talking heads of you should do this or you should do this. And I think it's really important for prospectives out there to really look at a combination of views and to really see what it will work for them and what they feel's right.
So would you say that it's been hard for us to build this portfolio?
I wouldn't say it's been hard. I think it's really important to have a team around you that can really assist you with that. For sure, you need clear perspective of what's happening in your portfolio, and that's what this sort of worksheet helps us do. We can really see a good bird's eye view of what's happening. If we don't have that, we're sort of just running in the dark. But if we've got this clear view of what's happening, as Munzrul was saying, this is performing, this is not performing as well, those sort of indicators, then we can sort of take action or that sort of thing. So I think it's really important.
It's good. I think it's an important point that Munzrul made to me probably a couple of years ago now, because I was like involved in the operational components of running this portfolio. I was dealing with estate agents. I was having to advise on, yes, go and fix a garage door, or get a new hot water system or whatever. And Munzrul said, Phil, mate, you shouldn't be doing that sort of stuff. You know, you've got a portfolio now that someone needs to own that particular component of it. And it was really good advice. And I was fortunate that Michael was able to pick it up. Someone had the aptitude from an accounting perspective, but also understood the long-term goals, where I now am not involved in having to make those decisions, or we've got parameters for when I need to be involved in a decision-making process. And what's that meant is that I have a lot more time, and, my time is more valuable doing other things which are more income generating orientated. That's a number one point. Number 2 point, things get slowed down if I was involved with it. So now a lot more things happen faster because I've got someone looking after this component for me. And number 3, opportunities are now able to be realised quickly because we actually have better capabilities to deliver to banks and lenders or my broker the information they need in order to skill me finance. So that is a really good point.
Yeah, and look, I think it's really important that we do, like, with this portfolio, we do work as a bit of a team, and it's really important to recognise the work that our property managers actually do as well, because a fair bit of work that they just come and they we work as a team with them as well, and they'll say, okay, we have X, Y, Z, this needs to happen, and then we can just boom, get it done. I think that's really important to have really good property managers as well.
So what's your tips, Monzrul? This is the way we've chosen to manage our portfolio, and on your advice. And I know you probably have someone similar within your business that looks after your portfolio and does all that sort of absolutely essential stuff. When do people need to start thinking about the complexity of managing a multiple property portfolio, and people probably get stuck quite a lot and things start going wrong? What's your recommendations on how to manage a portfolio like this?
No, fantastic. Very, very, very good question. Look, I would still suggest that, Phil, on day one, when you sort of were managing absolutely everything on your own and sort of all the sort of the day-to-day sort of the decision-making, that the door is broken down and the curtain sort of flown away, right? All this decision-making, I think there is still a strong merit to it. It's about being hands-on involved, and it's about really filling the game as well as understanding the game through filling the game as such. So I would say that any new investor who comes in, that initially it's rather important, stay involved with absolutely every single step along the way, and you would learn quite a bit. And then what it does is that while the portfolio starts to become bigger and bigger and bigger, and complexity sort of start to sort of increase over a period of time, you would sort of fill it. You would fill it at a point of time that you sort of say that, well, you know what, it's the time that I'm sort of spending. Not that it's not valuable, it is valuable, but there is a better value that if I take a step back, I get to view the macro view because I have that micro view as such. So my recommendation quite strongly would be with the investors is that start with yourself, so that you get involved with absolutely every single step and you learn it, and along the way the delegation will sort of naturally come in. So
you need to do your apprenticeship. You need to get your hands dirty.
That's right.
So what decisions would you get involved in now in your portfolio?
Yeah, good question. Because see, I look back in 17 years, right? So I was started exactly the way you sort of were doing. I was an absolute control sort of maniac, if I may, that I used to control every single decision. Do this, no, it needs to be my way, my way.
His head, yeah.
Yep, 100%. Yep.
My way is the only way, right? There is no other way. That is the way, right? And I know everything. That's how I started. But then I very quickly realized that, hang on, that's a little bit immature and not as wise as it should be. So I started to relax a bit. I was started to see the bigger picture. I started to sort of see that, well, I might have given away $100 here and there as such, but it's the longer period of time as such. So I started to do it, and I was still investing on my own. I was still managing everything. I was still buying everything. I was doing it. And I reached at a level that I've sort of seen that the time has become such a demand that because I don't get around to it, is the opportunity cost has become far too high. And the opportunity cost is not so much in terms of the day-to-day repairs that I should be doing, and rather than having one cost indication, we should be really getting about 3 indication, and we only get 1 because we don't have time. But it's the opportunity cost that I don't have the time to take a step back, look into from a strategic perspective, that how do I expand? How do I do the BD, so to speak, as opposed to becoming just the general manager as such, right? So that's sort of, in my case, that sort of happened after about 10, 12 years later.
Okay.
And this is where I've sort of brought in someone initially sort of a day or two, and then that sort of became more sort of a part-time, and that sort of become more of a full-time sort of basis as such.
Interesting. That's a good point. So we've run out of time. That's a long time, is it? A little bit longer than normal. So, but I really enjoyed the chat, Monzrul. Thanks.
Thank you very much.
It's really good. Appreciate you coming. Let's get you back in. I want to keep talking about just some of your tips about how our listeners can be better property investors on the financial side, taxation side, compliance side. So let's get you back in a couple of weeks' time,
sure.
And let's go through that.
Love to.
Mate, Michael, thanks. Did well, mate.
Thanks for having me.
Thank you,
Yeah, good.
Thank
good.
you, Phil.
Just to summarise this podcast, and I know there'll be a lot of questions, so make sure you email them through to me, editor@smartpropertyinvestment.com.au. We're throwing a lot of numbers at you, and hopefully they make sense. I've tried to keep it pretty simple as possible. I guess the summary is that it costs us a little bit of money to hold this portfolio, but the portfolio is growing at a rate which far outweighs any of that, and I have the confidence and comfortable position to be able to meet that cash flow. It's just a slight cash flow shortfall in the big scheme of things. If you do it as a percentage, it's absolutely nothing. But it's about knowing your limitations. So you need to be comfortable as a property investor with your cash position and be able to manage different times in different markets at different levels of maturity of your portfolio to meet the cash flow needs. But all in all, 49% compounding growth, consistent compounding growth, or average compounding growth year on year is pretty good. I challenge anyone to try and get that anywhere else without betting the farm on it. So we're quite happy with it. There are, and Monzrel works with a lot of investors. There's other people getting the same stuff, and what they're doing, they've got good strategy, they've got good people behind them, they're not taking risks. My portfolio is boring, to be fair. There's nothing really exciting about it, and that's one of the interesting things. So, summary, know your cash position, use your real numbers, don't try and fabricate it or paint a picture that isn't true. You need to actually know the ground truth of your portfolio. You need to actually know your actual situation at any point in time, because that's going to empower you to make the investment decisions that you need to make. Going on what Monzrel will say, good management is absolutely key, and you need to think about the opportunity cost. So if you need to spend a little bit of money to underpin your ability to manage your portfolio so you can capitalize on those opportunities when they arise, I'd be looking to invest in that. So thanks everyone for tuning in. I know we'll get a lot of comments and people wanting more from Monzrel, so we'll make sure we do that. Remember to go to smartpropertyinvestment.com.au. You can go to all the Twitter and Facebook stuff, Instagram, I think. You can follow me at Philip Tarrant. Any questions, just get in touch. Thanks for tuning in. We'll see you next week. Bye-bye.